In this session, I'm going to deal with the computation of the forward and the futures prices for different kinds of derivative securities. Right from the derivatives on stocks, bonds, currencies, and commodities. We would typically try to see how do I compute the forward price for those kind of entities, derivatives on those kind of underlying securities, and even for the futures, what kind of differences exist between the forwards and the future prices, especially for these kind of securities, right? So, to get into it, first of all, I need to have an understanding on whether the underlying asset is an investment asset or a consumption asset. What is the difference between these two? When I'm talking about an investment asset, that particular asset generally is held by good number of investors, primarily from an investment perspective. Some people may still use it for a consumption perspective, but majority of the participants, they invest in it. They purchase that from a perspective of investment rather than from a perspective of consumption. So, though gold and silver can very well be used for some kind of consumption purposes, they are used as raw materials for producing something, but majority of the people make their investment in gold primarily from an investment dimension, not from a consumption purpose. So those kind of assets are all categorized as investment assets, whereas any kind of assets which are used primarily from a consumption perspective, probably when I'm investing something in oil or copper, the intention is copper is used as a raw material for preparing for manufacturing lots and lots of products. So that is more of a consumption kind of an asset. Oil can be used for either household consumption or industrial consumptions. So it's more from a consumption perspective, not from an investment perspective. Whereas when I talk about, let's say, stocks or bonds or any financial investments, financial instruments, I'm trying to invest in them primarily from the perspective of investment. But if I'm looking at commodities, some kind of commodities come under the consumption commodities, some other kind of commodities come under the investment commodities. We need to have some kind of an understanding or a clear-cut differentiation between these two groups of assets because the valuations differ between these two groups of assets. So we are typically now looking at the determination of the price for each of these. Initially, we will focus on investment assets and then slowly move on to the consumption assets as well. And what we could typically see is the concept of arbitrage, a risk-less profit. That particular concept can very comfortably be used in case of investment assets to arrive at their forward or futures prices. But the same cannot be applied in case of consumption assets because we are not talking of purely an investment. It could be consumed from now to a month later. So a pure arbitrage concept cannot be used for the pricing for consumption assets, whereas when it comes to investment assets, I can comfortably use the arbitrage concept. And one more important point that we need to understand in this context before we start getting into the pricing processes is we use the word shorting, or probably sometimes we call it short selling. What this actually means as a terminology is selling something without owning it. Now, how can I do that? Selling without owning? I can borrow from the broker. I can borrow from the broker, which means broker is going to take those assets from someone else, from some other client, and lend it to me. And from that lending, I'm going to sell it off. So I'm going to get the proceeds of that. And at a future date, probably I'm going to buy back those securities from the market and return them back to the broker. And if at all I am able to make a profit in it, that profit belongs to me, otherwise the loss belongs to me. So that is what is a typical mechanism of short selling. I am borrowing something from the broker, and based on whatever I have borrowed, I am selling it in the market, and I am taking the proceeds then and there itself. But in some cases, what could very well happen is the broker may not be able to borrow any more securities. The broker may be having a restriction in terms of taking from different clients. He is not able to get the securities from the different client, or probably the client is very much determined to sell off his securities, so he is demanding his securities back. Then I cannot wait until an opportunity comes back for me to buy back at a favorable price. I may have to close this short position immediately so as to give back the securities back to the broker, who may have to replenish his clients, replenish them back to his client. So in that case, I am forced to close out my selling position, and that is what we typically call as short squeezing, because my short position is getting squeezed. I am forced to close out the short position even if I am not ready to do so. And as a part of this entire short selling process, whatever the proceeds that come, so this is generally done under the intention that the security prices are going to fall in future. Right, if the security prices are expected to fall in future, now I don't have the security, so I have borrowed them, sold them in the market. So currently the price is much higher, so I am going to receive a higher amount. And because the security price is expected to fall in future, probably after a certain point in time when the securities price has fallen, I'm going to buy back those securities and refund them back to my broker. So I might have bought them at a lesser price, and because of that buying out at a lesser price, I am able to make a profit in the process, and that profit is completely belongs to the person who has got into the shorting process, which is me. But in this process, whatever the dividends that are declared, or whatever the interest that comes, if the shorting has happened not on shares but let's say on bonds, whatever the dividend has come out, whatever the interest that is going to come between this shorting period and buyback period, whatever the company has declared the dividends or the interest, this person who has shorted, he has to refund it back to the broker, who would be giving it back to the client. So the client would still be the owner, because this is just a borrowing here, whereas this party is still the owner. So the dividends and all are belong to this particular client who has lent the securities. So any dividends and all that are received during the period, they need to be refunded back to the client. And In this entire process, the investor has to maintain a margin account with the broker. Just like we talked about the margin account in case of futures contract, here also we are talking about in any kind of a short selling process, the investor is required to maintain a margin account. So this margin account can be filled with cash or any other marketable securities which can be converted into cash quite easily. And see, this margin is like a protection in case the securities price is not falling but it is rising, and then the investor who has shorted the security is actually losing. To make sure that this person who has shorted is not defaulting or is not refunding the securities back, this margin will be acting as a cushion in that case. So this is again, there is an initial margin, the initial deposit that needs to be made, and probably if at all required, an additional margin also can be requested by the broker. And the main intention is in case the person is defaulting because the security price is going up, not falling, to protect the client against the loss of the securities, this margin is really helping out. And one more advantage is, even though a margin is deposited, generally interest is paid on the margin balance. So that means whatever the margin that has deposited, even that is carrying some additional interest also. And whatever the proceeds that come, they all completely belong to the investor only, except for the dividends and the interest that come, which belong to the original client. Whatever the sales proceeds that come, whatever the additional profit that comes, that entire thing belongs to the investor himself. That is what is one motivating factor to get into the shorting process. And before we get into the pricing, before we get into the pricing, we had looked at few dimensions. One, whether the asset is an investment asset or a consumption asset. We have also tried to understand the concept of shorting, because we will be using this quite frequently in this pricing applications. And we also need to understand some key assumptions that we work with as a part of this pricing process. Some of the key assumptions that we go with is no transaction costs, right? Brokerage costs, commissions. So there are no transaction costs to any of the market participants. The tax rates are more or less similar to everyone. Some basic assumptions that we go with in all these pricing understandings. All the net trading profits, they are taxed at more or less the same rate. The participants, they can actually borrow at risk-free rate, and they can even lend at risk-free rate. Probably this is slightly away from reality. Lending at risk-free rate is something that is in the hands of the person, but borrowing at risk-free rate is something that is not in his hands. It depends on the lender at what rate, and definitely the lender looking at the credit risk associated with the person may not definitely lend it at the risk-free rate at all. And the market participants are quite active. They take an advantage of any kind of mispricing that come up at any point in time. So they wait for arbitrage opportunities, and they try to take an advantage of the various arbitrage opportunities that come up. Now all these things, generally we assume that every investor, or at least a few key large scale investors, they are all these things are applicable at least to large number of derivative participants. So they are taking advantage of the mispricings, and they are ready to exploit the arbitrage opportunities and all. And using all these things, we are trying to arrive at computing the forward price or even the futures prices for various investment assets as well as consumption assets. So here we use the risk-free rate, which is the rate at which the borrowing or lending can happen, even in case there is no credit risk at all. So typically associate the rating that is the return that is expected out of the government securities. But from a reality perspective, as we have seen earlier, LIBOR is a better replacement for the usage of the risk-free rate than the traditional treasury bond rate. Though the treasury bonds are more or less AAA rated with almost no chance of default because of their artificially low level of returns because of various tax and regulation issues. Derivatives dealers generally prefer the LIBOR rate to be the replica of the risk-free rate, and LIBOR is generally used as a proxy for risk-free rate for all the computations relating to the forwards and the futures pricings. All right. Now, with this as a base, we will start getting into the pricing of the forwards. So we'll get into the pricing of forwards for an investment asset to start with. And within this, we try to look at a couple of dimensions. Investment asset with no income, no intermediate income. This is one category I would like to see. Then I am talking about an investment asset with a fixed known income, and a third category where I talk about known yield. These three categories of investment assets is what I am initially going to look at, and we try to find out the forward price associated with these three investment assets. Alright. So first, looking at that particular investment asset which does not provide any kind of an intermediate income. Generally, non-dividend paying stocks or zero coupon bonds, they all fall into this kind of a category. How do I do the pricing for the forward contracts for such a kind of securities? Straightforward. If at all I am talking about a forward contract on these kind of securities, whose current price, let's say, is S0, I can directly say that they are linked with an arbitrage relationship. The forward price F0 is nothing but S0 into E power RT. The forward price should be equal to S0 into E power RT. So probably if it is like, if we are talking about a 3-month forward contract where the risk-free rate of return R is 6% and the current spot price of that particular stock is 100, then all I am saying is the forward contract on this kind of a security should be priced at, if I am saying S0 is 100, R is 6%, and T, which is the time to maturity of the forward contract, we said 3 months, so it's 0.25 years. Then, as per a simple calculation, the F naught, which is the forward contract, the forward price should be straightforward, coming out as S naught multiplied by e power RT. Now, which means this should be equal to 101.51. Theoretical forward price. Theoretical forward price should be 101.51. Now, in reality, in the market, the forward price could be greater than 101.51 or it could be lesser than 101.51. Now, what happens? If the forward price is greater than 101.51, let's say the forward price is 102. What will the user do? Any user, let's say I am the investor. What will I do? Because the forward price is greater than the no arbitrage price S naught into E per RT, what I'll do is I will buy the okay, I'll take a loan for 100, right? With that loan, and that loan I'll take at a risk free rate which is at 6%. So I will buy the security with that 100 bucks, right? That is what I'll do today. I'll take a loan at 6% because I can borrow unlimited at risk free rate. So I'll take a loan at 6% for 100 bucks, and with that 100 bucks I am trying to buy the security in the spot market, and at the same time I get into a short forward contract because short forward is available at 102, means I am actually agreeing to sell the security at 102 after 3 months. So now these are the transactions I will do today. Today I'll take a loan at 6% for 100 rupees, and this 100 bucks I am going to use to purchase the shares or security, and at the same time I will initiate a short forward contract for 102 as for a 3-month expiry. Then after 3 months, what is that I am doing? I am delivering the security. So when I deliver the security, I get 102 because the agreement has been made for 102. I get 102 when I make a delivery, but to the bank I have to pay at an interest of 6%. So I'll pay 101.51 to the bank. So obviously I am making 0.49 perfectly. Whatever may be the situation, I am able to make a perfect profit of 0.49. No, not more than that, not less than that. So my profit is assured without taking any risk, and that is what I am calling as arbitrage profit. So without taking risk, if my profit is coming up, then that is what we are calling as arbitrage profit. And if the volume of this transaction is going up, why only one? If I do this trading in some million such securities, then probably my profit of 0.4 times 0.49 times million, which is almost 490,000, is assured straightforward. So this is the reason, if one person is able to identify this opportunity, he is going to exercise this very heavily, which means the more forwards get sold, more and more forwards getting sold, their price is going to come down, more buying is going to happen in the spot market, right? And because of that, their price is going to go up, arbitrage opportunity is vanishing out. So what we say is, I can apply the concept of no arbitrage in this kind of scenarios. At least for the investment assets, I can directly apply the no arbitrage scenarios and try to do the pricing for them. So in case of an investment asset which does not give any return, the no arbitrage forward price at any point in time should be equal to S naught into E per RT. even if it is the other way, let's say the forward price was only 101, then what the person would have done is he go long on the forward today. Go long on the forward, you short the security today. And if I am shorting the security today, I am going to get 100 bucks, right? Because the current price of the security is 100. I am shorting it, I'll get 100. Deposit 100 in a bank for 3 months. When I deposit after 3 months, I'm going to get 101.51. But I have got into a forward contract that I will buy the security at 101 after 3 months. So use the proceeds to buy the security from the counterparty and return the security back to the broker. So in this process, I am left with 0.51 for each transaction. And because this is again an assured 0.51, you can find lots and lots of players are going to go long on the forward contracts, which means the forward price is going to increase from 101. They are going to short the security, means the security price is going to fall down in the future. Again, the arbitrage opportunity gets vanished off. So that is where we say, even if F naught is greater than S naught into E per RT or less than, then arbitrage opportunities are definitely existing, right? So that is where we are talking of, if at all no arbitrage opportunity should exist, then we are talking of the forward price should be equal to S naught into E power RT only, right? This is one such scenario, S naught into E power RT. Then the second example I am looking at is, if there is a forward contract on an investment asset, which has a known income. Known income means in dollar terms the income is already known, like there are stocks with the dividend, with known dividend. I know when they are going to pay a dividend and how much they are going to pay as dividend in terms of dollars, or probably the bonds which are having fixed coupons. All these kind of investment assets are typically being considered for a forward pricing. And in that kind of a scenario, what we are simply saying is the no arbitrage forward price comes out as S naught minus the present value of the dividends or income, whether it is dividend or coupon. Present value of dividends during the contract period. Whatever the dividends or coupons that are expected to come during the dividend period, I adjust the S naught with that. I subtract the present value of the dividends that are expected to come during the contract period, and that adjusted S naught I'll do E power RT. Earlier, when there was no income, we simply said F naught equal to S naught into E power RT. But here, the S naught is getting adjusted by subtracting the present value of the incomes that are expected to come during the contract period. Any incomes that are going to come after the contract is expired, I am not bothered about it. But something that is expected to come during the contract period, I take the present value of all those incomes, I subtract it from the spot price, and from the resulting spot price I am going to multiply it by E per RT. That should be the price that is associated with the forward contract corresponding to the securities with known fixed incomes. Anything more than that or less than that is going to give rise to an arbitrage opportunity, just like the way I have discussed earlier. Now, probably for understanding that, let me take one example. Probably I am looking at a 10 months forward contract. Right, I'll look at a 10 months forward contract on a stock. Let's say the current price of the stock S0 is $100, and the risk-free rate of return, I take it as 6%, and let's assume that the dividend wise there is a $2 dividend that is going to come after 3 months, and a $3 dividend that is going to come after 6 months. So that is what I'm expecting. And if that is the case, what should be the price of this 10-month forward contract on this particular stock? Right? So just trying to put it, I'm looking at the current stock price being 100, and the maturity period of the forward contract is 10 months. So I convert it into years, it's becoming 0.83 years. The risk-free rate of return is 6%. Now the dividend, there are two dividends that are going to come. Probably if this question had been extended, saying yes, another $5 dividend after 12 months. Now this is irrelevant for me because the contract is only for 10 months. I don't consider the last one at all. So the dividends wise, there are two dividends that are coming up. One is a $2 dividend coming at the end of 0.25 years, and there is one more dividend which is $3 coming at the end of half year. So I have to find out the present value of these two dividends. Now what is the present value of this dividend? This divided by e power RT. E power R and T. So 1.97 is the present value of this. This divided by e power R T. So this is 2.91. So the adjusted S0 for me comes out as S0 minus of the dividends that are declared during the contract period. So this is adjusted S0, and based on this I am going to compute the forward price. Adjusted S0 multiplied by e power R T. The T is the contract period, which is 10 months. So this comes out that this forward contract should be priced at 99.99. The no arbitrage forward price for this kind of a contract should be 99.99. It can't be more than that, it can't be less than that. Anything more or less is going to give rise to arbitrage opportunities straightforward. Then the third dimension that I am bringing into this evaluation is the investment assets with known yield. It's not a known fixed dollar dividend amount, but we don't know the exact dollar amount, but we know it as a percentage of the assets price. So probably it's like a particular security is going to declare a dividend of 2%. 2% of the assets price. So whenever we are looking at dividend being declared as a proportion of the assets price or assets value, we are considering it as the scenario of a known yield. So in that case, wherever especially when we deal with the index based forwards, or probably in case of stocks which give a dividend in percentage terms rather than a fixed dollar amount every time, a percentage of the stock price, then I can consider this kind of a mechanism. Right, so in this case, the no arbitrage forward price goes as S naught into e power R minus Q into T. Q is that percentage dividend or percentage of the income that is going to be provided at every point in time. So if at all any particular asset, any particular security is going to give a return of or a dividend of Q% per year, then I could very much consider this as a part of my expression straightforward and find out the value of the forward contract itself. So it's as good as saying, okay, if I want to consider a forward contract which is expiring 6 months from now, and on a particular asset which is going to pay 3% dividend every year. 3% dividend every year. And when I look at the risk-free rate being equal to 6%, and let's say the current spot price is 100, it's as good as saying the forward price on this particular kind of a security is S naught into e power R minus Q multiplied by T, 6 month forward contract, which is going to work out to whatever is the value that should be the price that should be associated with this forward contract where there is a known yield. Anything more than that or less than that is going to give rise to the arbitrage opportunities itself. Right? So these are the three major dimensions, especially with the basic investment assets dealing with stocks and bonds. Either these stocks and bonds, they provide no income, no intermediate income, or a fixed intermediate incomes at different time periods, or fixed yields at different time periods. In all these cases, how do I price the forward contracts is something that we have looked at till now. Now, this is the price. This is the price we are talking of on that day we have entered into the forward contract. Right? On the day of entry into the forward contract, these are the prices that should be mutually agreed upon by the short position as well as the long position. But as we progress, let's say I have entered into the contract on 1st Jan and the expiration of the contract is 31st March. Now, probably on 15th Jan, I want to know whether the forward contract which I have entered into is profitable to me or is it loss making for me. Right? What is the value that forward contract is creating to me on 15th Jan or on 28th February. So on different dates I want to check out as I move from the date of the contract towards the expiration. At different points in time, if I want to check out what is my position currently, what is my value currently associated with this forward contract, if at all I want to do those kind of calculations, we call that kind of a processes as valuing forward contracts. So which means associated with every forward contract, On the day of entry into the contract, we determine the forward price. In majority of the cases, the forward price could be a no arbitrage forward price. And after the entry, so during the contract period, we are trying to determine the value of the contract. Is it positive for me? I mean, am I beneficial or is my counterparty beneficial? Is it negative to me? So finding out the value at a point in time after the contract got initiated. So for all the three contracts which we have discussed above, for the stocks and bonds where there was no income or a fixed income or a known yield. So in those kind of contracts, if I want to really find out the value associated with the forward contract, what is that I have to typically follow? One important point in this context is the value that I am talking about for a forward contract on the day of entry, on day 0, on the day of entry into the forward contract, it is 0. Means no party is at an undue advantage or a disadvantage, and it's a completely no arbitrage kind of a forward price. So the parties, both the parties don't have any kind of undue advantage or disadvantage, which means both the parties are carrying a value of 0 on the day of entry into the contract. But as we move along, right from day 1, after the contract has been initiated, one party would be having a positive value, the other one is going to have a negative value. We are looking at the value at the end of each of the periods so that we can assess which party is gaining and which party is losing. And what we are simply saying is, if at all I want to assess the value of the forward contract at any point in time, we are trying to look at the price at that particular point, the price of the security at that particular point. Let's say at time t I want to look at the value of the forward contract. I'll take the spot price at that particular point in time, and whatever is the forward price that we have agreed upon, the forward price that we have agreed upon, which is F naught, let's say, the forward price that we have agreed upon, I'll discount it to that present value as of the time period t, and if it is positive, then it is the value is positive to the long position, and if it is and it is negative to the short position. And if this value comes out to be negative, I say it is negative value to the long and positive value to the short. Okay, let me take an example to explain it more clearly for you. Okay, we are talking about a long forward contract, right? Probably the same example, let me consider. There was a forward contract that we have entered in for 3 months. Let's say after 1 month, the price, after 1 month, let's say the price was 101, right? So we have initiated the contract for 3 months, let's say on 1st Jan, and the price has been agreed by both the parties for 101.51. Now what we are saying is 1 month has elapsed, and after 1 month I have seen that the spot price is going to be 101. If that is the case, what we are saying is the value at that point to the long is the spot price at that point minus the present value of the forward price. Forward price is 101.51. I take it as the present value e power r t. T is 2 months only because 1 month has already elapsed. So I'll take it as 1 by 6. So in this case, if I am taking the value value to the long position, I'll take it as the spot price at that particular point minus the present value of the forward price. So I'm taking it as the forward price which has been agreed upon divided by e power r t. T now is only 2 months. 2 months, so which is nothing but 2 by 12 years. So which is working out to the value to the long is coming out to 0.498 $0.498, and this is positive, means the long is gaining. So it's a gain to the long, gain to the party which has entered into a buy position, and the same amount will be a loss to the party which has got into the short position. And if the value would have been negative, let's say after 1 month the stock price has become 100.4, then what we are saying, the value to the long is coming out as minus zero point 0.1. So the long is losing, the long's position is having a loss of zero point 0.1, whereas the short is having a gain of 0.1. So the parties can very well decide whether they want to continue with the contract, or probably they can decide whether they can talk to the counterparty and close the contract, or they'll try to reduce their loss by entering into another transaction with some other counterparty. All these kinds of strategies can very well be executed, and that is where we talk about going ahead with this kind of a value mechanism. The same logic, let's say here I want to apply. After 1 month, let's say the stock price has gone to 101. Same logic, after 1 month the stock price has gone to 101. Then what is that I can do in the second case? Because there are dividends. Now the dividends wise, I'm expecting this dividend in just 1 month. This dividend is going to come in just 2 more months. Now I have to work it out. Okay, what will I do? Now here I should have done them as by 12, because these are all should be converted into years. Even this I should do it as by 12. Alright, so this is the forward price. So let's say after 1 month the price has gone to 101. Then what is that I am saying? This dividends I have to adjust. Now I'll find the adjusted spot price now. Because earlier when we did the pricing, we said S naught minus the present value of the future dividends, and then I did E per RT. But now I am finding out, now for the value we talked about earlier, that I'll take the spot price at time t minus the present value of the forward price. Now the same logic I am talking of here, the spot price should be an adjusted spot price. So what I'll do is, for this 101, I'll try to adjust this 101 first of all. Now what are the dividends if it is only 1 month? So dividend divided by e power RT. T is 1 more month to maturity. So my dividend is going to be something like this. And in this case also I am talking about 2 more months to maturity. So RT 2 more months to maturity. So it is coming out to 2.97. Right, this is 2 more months to maturity. E power R okay, this has all right, this is 1 more month to maturity, this is 2 more months to maturity. So I am trying to find out the adjusted S naught now. The adjusted S naught is coming out as 101 minus this. So this is coming out to be the adjusted S naught. So that is where I'll try to find out the adjusted forward price. Our value now is nothing but whatever is the adjusted spot price 96.039 minus the present value of the forward price 99.93 was the forward price. I divide it with e power r and there is only 5 more months to maturity. So that is where I'll try to find out the value to the long here comes out as the adjusted spot price minus the forward price. I divide it by e power r t. There is 5 more months, or probably here we are talking of a 10 months forward contract, right? Because we are talking about a 10 months forward contract. We are oh sorry, let's go back. See, there was a dividend of earlier. There was a dividend of 2 declared after 3 months. So that's where we are talking about the present value of the dividend being e power r t, 3 more months, 0.25 years, taking it to 1.97. And in this case also after 6 months there is a dividend of 3 being declared. So that's where we had taken it as e power rt. That was what the pricing we have done earlier. Now because of this the value of the forward has come to 99.99. fair enough. Now I am interested in after 1 month the spot price has gone to 101. So after 1 month means the dividend, now this dividend is only 2 months away. So because this is 2 months away, I want to find out the present value of this dividend. So R and T is 2 by 12. So this dividend is 2 months away. Here I want to find out the present value of this dividend which is 5 months away. R and T which is 5 by 12. So these are the present values of the dividend. So I can now adjust the spot price saying whatever is the spot price, I subtract the present value of the dividends which is resulting to 96.09, and so when I have to find out the value to the long, I'll say the adjusted spot price minus the present value of the forward price. Now when I'm trying to find out the present value of the forward price divided by e to the power of r, and this time t, I have only 9 months to maturity, so I'll take it as 9 by 12. So this time again this is coming out to 0.49, 0.498, which is what is a positive value. So I can say that the long is going to benefit. Long is at a positive, long is having a positive value to this contract after 1 month. Short is having a negative value. The same logic again, if the spot price had been 100.5 instead of 101, we see that the long is having a negative value here because adjusted spot price comes to this, and when I am using adjusted spot price minus the present value of the forward price, it is showing a negative number, so it's a loss to the long and gain to the short. And similarly, when we are talking of known yield kind of examples, if I want to find out the value, instead of taking the spot price minus the present value of the forward price, I am simply adjusting the spot price here by dividing it by e power qt. Q is that known dividend yield, means because this Q percentage is going to come up every period. So I'm trying to adjust that particular dividend, adjust the spot price with that particular dividend. So the ST, I'm discounting it with e power QT to typically arrive at the adjusted spot price, and using this adjusted spot price I'm trying to compute the value of the contract. And now these are the forward prices and the values. What we have seen till now is computing the no arbitrage forward price at the initiation of the contract, and the value of the forward sometime into the contract, at some point into the contract. So these two are something which we have computed for an investment asset, one with no intermediate income and one with a fixed intermediate income and one with a known yields, right? And the same logic, whatever the logics we have used for the forward contracts till now, the same logics are applicable even for the futures contracts also. The only difference being whatever is the gain or loss that is coming up, the value that we are determining, this is determined on a daily basis, and because of the daily determining of the gain, the realization of the gain is happening almost immediately. And in some cases, this could be very much positive, so which means it is much more beneficial to go for a future compared to a forward, whereas in some cases it may not be anywhere positive, it may even turn out to be negative. Then it's better to go forward with a forward contract itself. But otherwise, at a very periphery, we could see this mechanisms of pricing as well as the valuation are more or less the same for forwards as well as for futures, right? Now comes an important argument. Are forward prices same as future prices in all the cases? Now for this there is some important study that has been performed. Whenever you see the risk-free rate is constant for all maturities, what we typically observe is until the expiration of the contract, if the forward, if the risk-free rate of return is constant until the maturity period for all kinds of for all the maturities during that contract period, then we can definitely say that the forward price will be the same as the futures price itself. But generally we can observe if the interest rates are fluctuating drastically during that period. Let's say if the contract is for 3 months period, during this 3 months if the interest rates are fluctuating drastically, then the forward prices and the future prices need not be the same. And for that, there is one more study that got performed. Let's look at the security price versus the interest rate. Look at the security price versus the interest rate. If there is a positive correlation between them, what does that mean? If the security price is increasing, the interest rate is also increasing. Okay. Now, if the security price is increasing, the long is gaining, the short is losing. So if the long has gained, he has got additional amount into the margin. Let's say we are talking about a future. So excess has come into the margin. And because excess has come into the margin, he can withdraw it and he can reinvest it, invest it. And the investing can happen at a higher interest rate. So obviously he is going to get a higher gain. So which means there will be a high demand for a future compared to a forward. For a long position, if the security price and the interest rate are positively correlated, the long is going to gain, and because of which he is going to get excess above the margin, which he can withdraw and he can invest, which can fetch a higher interest rate and a higher gain. So which means it is more and more attractive for a long futures contract than a long forward contract. Long futures becomes more attractive compared to the long forward contract. Similarly, in that case, we see that the futures price should be greater than the forward price because the futures is having more profitability, expected profitability compared to the forward. Look at now if the security price is negatively correlated with the interest rate. Now if the security price is going up and the interest rate is coming down, so whatever the long is gaining, that long he will not be interested to withdraw that excess because he may be forced to invest it at a lesser interest rate itself, which means he prefers taking the contract till the last rather than exercising it somewhere in the middle. In that case, the demand for a forward would be much higher than the demand for the futures, which means the price of the forward would be slightly higher compared to that of the futures. But keeping in view that majority of these contracts are short term, 3 months, 6 months kind of period, and the interest rate fluctuations within the 3 months and 6 months kind of a period may not be that drastically different. In practical terms, I may not find big differences existing between the forward price and the futures price, especially for the smaller time periods which we are considering. And apart from that particular aspect, even the taxes, the transaction costs, how the margins are treated, they all could bring out the differences between the forward price and the futures price. And But on the other side, we could see that the futures are more and more liquid. There are a lot of players operating in the futures market compared to the forward. So on one side, the default possibilities are much lesser. So keeping in view all these dimensions, in some cases we see that the forward price would be more than the futures. In some cases it could be lesser than the futures as well. But we need to understand the key differences that differentiate the forward price from a future price. Otherwise, the no arbitrage concept, the valuation concept, they are the same when we look at the forwards or even the futures. So probably I can use them interchangeably except for these small differences that are existing between the two, right? Now, the next forward or a future. Forwards generally may not exist very heavily on the stock indices, but there are a lot of future contracts that are available on stock indexes, which also generally is looked similar to a security investment asset with a known yield kind of a model. Even the futures are typically considered similar to that of an investment asset with a known yield. Here the yield is more or less looked at as the dividends that are generally declared by all the constituent securities as a whole. In percentage terms is what is typically considered. So stock index futures generally is very heavily used for managing equity portfolios. Right, a short position in the stock index futures is being looked at as a shield against the portfolios which various fund managers and portfolio managers are holding, and generally looked at in this particular way, which means the forward price or the futures price comes out as the spot price into e power r minus q into t. So that's the way we expect. So q becomes the dividend yield, and what we see is the dividend yield generally varies on a week by week basis throughout the year. It is generally published by the exchanges. So I can take that particular number and try to create a forward or a futures contract which is completely on a no arbitrage kind of a basis. And if at all the forward or a future price is either more than that or less than that, the arbitrage opportunities are going to be created just like the same way as that of the stock itself. But in reality, we cannot talk about shorting. We cannot talk of shorting the index or buying the index. We are looking at identifying. When I'm talking of buying the index, it's like buying all the constituent securities in that kind of a proportion. So that kind of an arbitrage, if at all has to be implemented, it has to be through program driven kind of stuff itself. So only program trading or algorithmic tradings only can really bring out arbitrage opportunities with respect to the index futures contracts, right? Then one more contract that we can see in this context is the forward or a futures with respect to currencies. When I am dealing with respect to currencies, I will consider S naught as the spot exchange rate, and generally it is taken as for 1 unit of foreign currency, number of units of domestic currency. Number of units of domestic currency for 1 unit of foreign currency. So if I am saying $1 equal to 60 Indian rupees, then I am taking S naught as 60. And if at all I want to get into the forward contract on this exchange rate, we are saying S naught into e power r minus rf times t. Here we are talking of r means the domestic exchange, the domestic risk-free rate of return, and RF is working out as the foreign country's risk-free rate of return. So if at all I am talking about the current spot exchange rate between US dollar and Indian rupee is 1 US dollar equal to 60 rupees, and the risk-free rate of return in India, let's say, is 8%. Risk-free rate of return in the United States is, let's say, 3%. I'm talking about a forward contract for 6 months or 1 year. Then the no arbitrage forward price comes out as 60 times e to the power of 8% minus 3%, 5% times 0.5. So 60 into e to the power of 0.025, 2.5%, working out to, this works out to typically 60 multiplied by e power 0.025. So giving me around 61.51. So what we are saying is 60, the exchange rate at the no arbitrage exchange rate after 6 months, going with 8% interest rate in India and 5% interest rate in US, is more like it's going to give me 61.51 as the forward rate. Anything more than that or less than that is going to fetch an arbitrage opportunity. Let's say right now we have got into a 61.51. Let's say after or probably let's say the exchange rate or the forward rate that is available in the market is at 62. Let's assume that the forward rate is available in the market at 62. A forward contract is available in the market for 62. Now what I can say, I can sell the forward, means I can sell $1 at 62 after 6 months. So what I'll do now, I will buy dollar now. So I will buy $1 now. So if I have to buy $1, what is that happening? I have to pay 60 rupees for $1. So I'm investing 60 rupees. I'm investing 60 rupees and getting $1. This 60 rupees is borrowed at, let's say, 8% interest rate. So at the end of 6 months, this 60 is going to become 60 into 1.08, or probably 60 into e power 8%. So this 60 is going to become 60 into e power 8%, which is working out Alright, let's create this transaction. Okay, I have borrowed, let's say the no arbitrage forward price is going to be 61.51. Let's say the forward market price is going to be 62 rupees a dollar. So I am going to sell the forward. So selling the forward means I am going to sell dollar at 62 bucks after 6 months. Okay, now for that I need to have dollar with me. What I'll do now, I'll borrow 60 bucks today, 60 rupees at 8%. So which means at the end of 6 months, how much I need to pay to the bank? E power 8% multiplied by 0.5 into 60. So at the end of 6 months, I have to pay to the bank, let's say 62.44 rupees is what I have to pay to the bank. But today, with that 60 rupees which I have borrowed, I have bought $1 because $1 is going to give me, $1 is currently 60 INR. So because of the 60 bucks that I have, I am able to buy $1. And that $1 I have invested for 6 months. And that $1 per 6 months has fetched me 3% interest. So I'm going to gain 1 multiplied by e power 3% times 0.5. That $1 was able to fetch me 1.015 at the end of 6 months. And this 1.015, I was able to convert it into rupees by 62, because I was able to sell the dollar at 62 bucks. So when I convert that into rupees, I'm able to get 62.93 bucks. But I have to pay to my bank only 62.44. Means the remaining 0.5 rupees is almost a gain that I am able to make. Similarly, if I look at it the other way, the no arbitrage forward price, let's say, is 61.51, but let's say the market forward price is only 61. Now, because the forward price in the market is much lower, I'll buy the forward. I'll go long on the forward. Go long on the forward means I will buy $1 at 61 after 6 months. I'll buy $1 at 61 after 6 months. Now what am I going to do? Whatever is, so if I have to buy it today, I have to short. So I will short dollar today. I will sell $1 at 60. Right? So I am getting 60 rupees as proceeds because I have shorted. Let's say I have borrowed $1, or even without borrowing, I have shorted the dollar at 60, and the 60 has fetched me an interest rate of 8%. So after 6 months, the 60 is going to give me whatever the 60 I have got because of the shorting of the dollar. The 60 is going to give me 62.44. Now the 62.44, I am converting it into dollars. The 62.44, if I am converting it into dollars at the rate of 61, because I have already agreed it at 61, I am going to get $1.023. But I have shorted the dollar. Means I might have borrowed $1 and sold it. So the borrowing, let's say, at 3%. So I am supposed to pay back $1.015. But now I have got $1.023. So which means my gain in this process is around $0.008. And even if I convert it at the whatever is the market price at that point, the gain for me is going to be around 0.52 rupees or something. But it is $0.008, which means I can very well create an arbitrage opportunity if at all I am able to perceive that the forward price is not following this no arbitrage kind of a relation. If the forward price is either more than S naught into E per R minus RF into T or less than E per R minus RF into T, we are able to create some kind of arbitrage opportunities which can really help us in terms of exploiting the profit. So from that dimension, we are directly talking about the forward prices at any point in time on any of these securities should be linked to the spot prices and connected by the no arbitrage kind of relationships itself. So these are some of the pricings and the values associated on the forwards and futures. We have dealt with the stocks, the bonds, providing incomes, providing yields, the indices, and currencies. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.